Welcome back to the Explainer, everyone. Today, we are hitting the whiteboard to totally secure your A-star in the IGCSE Accounting 0452 syllabus. We're going to master assets and liabilities classification. You know, this specific module trips up so many students every single year, mostly because it requires this tricky blend of really rigid rule following combined with high-level analytical thinking. But honestly, by the end of this session, you are going to have it completely locked down.
So, let's just dive right into it. What actually separates a good student from a top-tier A-star candidate when it comes to this incredibly dense syllabus module? Is it just memorizing formats? Well, no, not quite. It's really about bridging that gap between basic data entry and actual, high-level financial intelligence.
To get you completely exam ready, we're breaking things down into 4 critical whiteboard sessions today. We'll start with the foundation, move into technical execution, step up to interpretation and ratios, and finally, we'll look at some direct insider secrets from the examiner reports.
Okay, kicking things off with part 1, the foundation. These are your absolute non-negotiables.
Let's start with a quick concept recap. You absolutely must understand the golden rule of accounting, the accounting equation. It dictates that your assets must equal your liabilities plus equity at all times during the fiscal period. You have to really grasp the duality of every single transaction and the business entity concept. Think about it. If a business buys a new delivery vehicle using a bank loan, sure, their assets go up, but so do their liabilities. Maintaining this equation flawlessly is your primary architectural requirement. Every transaction has 2 effects. Miss one, and the whole structure basically collapses.
Now, pay close attention to this next part, because Cambridge has updated the syllabus for 2026. This means you need 100% accuracy using modern international terminology. You must write irrecoverable debts and owner's equity. If you use outdated phrasing like bad debts or capital, you're just signaling to the examiner that your knowledge isn't current. When an exam question asks you to state the accounting equation, using this precise 2026 terminology is literally the only way to guarantee full marks.
Which brings us right to the prudence concept. Examiners constantly, and I mean constantly, see students overstating profits by ignoring potential losses. That is a massive violation and a glaring red flag. Say your closing inventory is damaged, or maybe it's obsolete. You must value it at its net realizable value, not its original historical cost. The rule of thumb? Potential losses must never be ignored, while potential profits should never, ever be anticipated.
All right, moving on to part 2. Let's look at the engine room, the actual mechanics of technical execution and T accounts.
Now that our foundation is rock solid, let's see how this plays out on paper. Think of this procedural flow as your roadmap. Everything has to start from a correct business document, right? Like an invoice, a credit note, or a bank statement. From there, you move to the books of prime entry, you secure perfect accuracy in the trial balance, and then you seamlessly transition into the final financial statements. You simply have to follow that logic perfectly from step 1 all the way to step 4.
Now, here is a crucial tip for securing those top grades: method marks. You have to show all your workings, especially when you're dealing with complex adjustments for things like depreciation or accruals and prepayments. In the IGCSE exam, examiners will actually award you method marks just for displaying a logical flow. Yeah, even if your final mathematical balance ends up being totally wrong. So never leave a working out box empty. If you miscalculate the depreciation for year 1, but you correctly apply that incorrect figure to year 2, you can still pick up marks for using the correct method.
Let's look at ledger execution with a quick worked example. When you're tackling the T account structure, you absolutely must master balancing. The IGCSE command word you'll usually see here is prepare. So, if you are asked to prepare a cash book, you've got to correctly distinguish between a balance C/D, which is the closing balance carried down at the end of the month to make both sides equal, and the balance B/D, the opening balance brought down to start the next month on the opposite side. If you mix these 2 up, your double entry fails entirely.
And to really secure that A-star, you have to avoid some very specific mathematical pitfalls during this technical execution. 2 of the biggest errors we see: first, miscalculating percentages when applying trade discounts before cash discounts. Always deduct the trade discount first, calculate your new subtotal, and then apply the cash discount to that new figure. Second, completely omitting state symbols like currency signs in manufacturing accounts or financial statements. It just loses you easy marks. Keep an eagle eye out for these traps.
Moving right along to part 3, the real A-star difference, interpretation and evaluation, or AO3.
Let's walk through an AO3 evaluation question together. The exam might ask you to analyze the liquidity of a business. So you calculate the numbers, and you find that a business's current ratio has plummeted from a very healthy 2.5 to 1 all the way down to a pretty worrying 1.1 to 1. Essentially, this means they barely have enough current assets to cover their current liabilities.
Okay, I want to do a quick interactive pause right here. Actually, pause the explainer for a second, grab a piece of paper, and try to list 2 valid reasons why this liquidity might have dropped so drastically. Got your answers? Let's see. Calculating the ratio is just your baseline skill. Identifying exactly why it dropped, maybe they overpurchased inventory that is now just sitting there unsold. Maybe trade receivables are settling their accounts way too slowly. Or perhaps their cash reserves were totally depleted due to sudden capital expenditure, like buying new machinery. That kind of deep analysis is exactly what secures those evaluation marks.
Also, keep in mind that inter-firm comparison can be incredibly tricky in these evaluation questions. Why? Because different businesses use different accounting policies. One firm might use the straight-line method of depreciation, meaning they write off an equal amount of an asset's value every single year. But a competitor, they might use the reducing balance method, writing off a much larger chunk of the asset's value in those early years. This makes direct comparisons super difficult unless you deeply analyze the actual quality of the reported profit.
And when the exam asks you to evaluate long-term sustainability and return on capital employed, ROCE, you have to look beyond the surface numbers. You need to mention non-financial factors. We're talking about things like staff morale, physical location, the skill level of the workforce, and their overall market reputation. Sure, they aren't quantified in your T accounts, but they heavily dictate the reality of the business and its ability to actually generate future returns.
Finally, let's wrap up with Part 4. The insider secret straight from the examiner insights. Let's look directly at the principal examiner reports from recent years. Time management and respecting question weightage are obviously key, but examiners issued some very specific warnings about easily avoidable mistakes. First off, please do use clear, legible handwriting in your ledger accounts. It sounds basic, but students are needlessly losing marks simply because their numbers cannot be read by the marker. Second, do not confuse revenue expenditure with capital expenditure. If you treat a routine vehicle repair, which is a revenue item, as a brand new asset, a capital item, it will cost you dearly across both your income statement and your statement of financial position.
I want you to never forget this idea. Everything you are doing on this exam is building a transparent financial narrative. You aren't just doing math. You are translating raw, basic data into high-level financial intelligence. Every single ledger balance and every ratio you calculate tells a vivid story about the health, the efficiency, and ultimately the survival of that business.
Because ultimately, think about it. How can stakeholders, like the banks deciding on whether to approve a loan, the owners looking for their dividends, or the tax authorities assessing liability, how can they make critical annual decisions if the foundational assets and liabilities aren't classified with absolute perfect integrity? Your deep understanding of this module is what creates that necessary transparency. So, as you head into your exam, I want you to ask yourself, do you truly understand the story your numbers are telling, or are you just doing the math? Keep practicing those ledgers, apply those command words carefully, and I'll see you in the next explainer.